Hello and welcome to the Money Show, your one-stop destination for your personal finance queries. I'm Kavita Thapliyal, and today again we have a power-packed show for you lined up where we'll talk about your financial goals, your financial strategies for those goals, and your investment instruments that are right as per your risk appetite and your time frame and your financial goal. So all you have to do is, if in case you want to get your financial planning done live from our experts, you can send across your questions on our WhatsApp number, which is 8657974571. We also have an email ID, which is the moneyshow@etnow.tv, where you can send across these questions to us. And if it is any investment instrument related questions, we would request you to send your complete details in terms of your investment amount, your time horizon, and your risk appetite as well. Okay, so let's begin the show. And today, as an expert, we have on the show Shweta Rajani, Head Mutual Fund Anand Rathi Wealth. Shweta, hi, good evening, and welcome to the show. Shweta, we'll be focusing on our viewer queries, but then before that, let's talk about small towns, big story. You know, we are seeing a great interest in mutual funds from these small towns. In fact, the new investors that have come up from these smaller towns, the numbers have crossed almost 1 crore 30 lakhs. That's almost a jump of 32% that's been reported. We are looking at cities like Uttar Pradesh, contributing to more than 30%, Madhya Pradesh also close to 20%, followed by Jharkhand, Jharkhand and Bihar as well. But then having said that, this was also expected, looking at the AMFI SIP numbers every month and how we are seeing the retail interest coming up in the equity markets. Also, a big thanks to the fintech and the online industry, where they made it easy for investors to start their investments and even stop their investments, if we can say that. But having said that, this was expected. But then these small towns investment, how sticky are they? What do you think?
Absolutely, Kavita. So we've, over the last 3-4 years, we've seen the allocation from B30 as, AMFI's classified it, going up. A few, observations that I've had is that, one, when you look at the assets or what their investment pattern is, they're more invested in equity than in debt. And one reason for this would be that there is a shift, a long-term shift that we are seeing in their behavior of how they are allocating their financial savings now. Because if you look at, look at this data that comes from AMFI and look at the data that comes from RBI on the household savings pattern, we are seeing a shift where people are shifting out from the small savings schemes, deposits, and moving into equity. Today, equity mutual funds account for 6% of the
Shweta, we'll have to just stop you because there's a press conference going on by the CEA on the GDP numbers. Let's directly cut into that. All right, so Chief Economic Advisor V. Anand Nageswaram talking about the GDP numbers, where private consumption remains resilient and India outpaces several major economies. But then let's move on and let's carry on with the money show. And I will connect with our expert, Shweta Rajani. But before that, let's flash our WhatsApp number and email ID where you can send across your portfolio queries, because this is the show where we do your life financial planning as well. 8657974571 is our WhatsApp number. The money show at etnow.tv is the email ID. All right, let's carry on. And Shweta, hi, welcome back. And now let's begin with our viewer queries, Shweta, because I think it's that time of the show where we should begin this segment. Jitendra's question we'll take, Shweta, and he wants to know where to invest in mutual funds where he can get tentative returns of 15% plus. And he wants the high risk, high return kind of an investment suggestion. And he also writes that he's aware that mutual funds are subject to market risk. Now, that's very interesting. Shweta, one question to you. In what scenario would you calculate a 15+% return? What kind of a market scenario are we talking about over here?
Sure. Kavita, to answer your question and also to address what Jitendra has raised, see, if you're investing in equity, please to understand for a longer time period. The equity market returns are very strongly correlated with how your economy would move. And here, if you look at various forecasts coming in from IMF, World Bank, they're talking about India growing at a nominal GDP growth of around 10.5% for the next few years. So if I, look at the historical behavior and the strong correlation between the economy and equity markets, I would say the broader economy if I just do that top down, can also go indicatively at around that 10 to 12% range. Now, that's the broader economy, that's the index. We are talking about investing in mutual funds where the fund managers do play a very important role through active management, identifying specific opportunities and very actively managing the portfolio across sectors and stocks. So in that scenario, you can expect a good fund manager, uh, and rather a basket of good fund managers in your portfolio delivering maybe around 2 to 4% more than that. So if your economy grows at around 10-12%, which means the markets grow by around 10-12%, then expecting a 14 to 15% return is a reasonable expectation to have from the equity portion of your portfolio. Of course, a person would have an equity debt combination both. So overall perspective, the expectations can be different, but
Right.
this is when I would say a 14 to 15% expectation.
So, all right. So, this is also investing in equity only via mutual funds you're talking about, right? Because if someone has direct equity, that return percentage can still be higher. Is that right? Or you're talking about a combined portfolio where there is direct equity and mutual funds? Shweta.
See, I'm broadly talking about actively managed mutual fund portfolio with stocks. It can be very different. And, just to give you one data point, and I'm talking about extreme cases, look at the small cap index in the last 6 months. You've had one company which is given like a 60% return. On the other hand, you've had another company which has given a minus 15% return. Even in mutual funds, we've seen the average differential over a longer time period, between the best and the worst being 50%. So when you're talking about specific stocks, it can be a completely different picture. If you've created a small micro portfolio, it can also end up giving you a 20% plus return. But the hit ratio there, and the effort required to study those companies and stay invested would be very different than here you living it and giving it to a professional fund manager to do that job for you.
Let's move on. And what will be the recommendation? Because high risk and high return investment advice he wants from you.
Absolutely. So here, one more thing. If you're looking at high risk, doesn't mean that it will always translate into high return. Therefore, a portfolio which would be medium risk but has still the potential to give, I would say, above average return for you. I would say you can start off with maybe three funds. I don't know what's the amount that you're looking at, so I'm not able to give you a full advice. But what you can start off with is a portfolio of HDFC Dividend Yield Fund, a Canada Robeco multi-cap fund, and an SBI large and mid-cap fund. So with this, you'll get some exposure towards mid and small as well. But since I don't have an overall idea of what your current investments are, this is where you can start off with.
Jitendra, but we have Harsh on phone line with me. Harsh, hi, good evening. Harsh, can you hear me?
Yeah, I can hear you.
Okay, perfect. Hi, hi.
Yeah.
You
Hi.
want to read out the details of your portfolio?
Yeah.
Sure.
Yeah. So I am currently 38 years and I am looking to invest for 15 years. My target is 3 CR. Currently, I am doing SIP into 4 funds: Parag Parikh Flexi Cap 10,000, Motilal Oswal Mid Cap 10,000, Tata Small Cap is 10,000, and HDFC Flexi Cap is 10,000.
Sure.
So I'm looking out to add 15,000 more SIP from next month onwards.
Okay.
So can you please suggest which fund should I choose from the existing fund itself or any new fund should I add?
Sure. Sure. So these funds that you have already added, is this your own research or you have taken someone's help, a professional help?
No professional help, from my own and watching videos and all those things from the channels.
Okay.
I have taken some idea.
Okay, I think that's a good amount of funds and good mix of funds that you have in the portfolio. But then, yeah, we can still add more stability to your portfolio, Shweta. And 15,000 amount, 2 more funds, Shweta, or the entire amount can be divided in these funds only?
Harsh, overall, in terms of if I see your SIP that you're doing, if you can do a 10% step up to the SIP would be a good, a good thing to do. Coming to the specific schemes, most of your schemes that you have in the portfolio are good. So you can actually do a top up on these schemes itself. Just one scheme where I would say, I have a recommendation for you where you can change is your Tata Small Cap Fund. So that's the fund I would say, if it's out of an exit load period, move out of it. And if you are doing an SIP, you can stop your SIP there. What you can add on instead of the Tata Small Cap Fund, if you want to the portfolio, then you can consider adding on to maybe a ICICI Pru Focus Equity Fund, or you can go in for one Canada Multi Cap Fund to the portfolio. That's some suggestion, but the other schemes that you have are good enough.
Anything else you want to ask, Shweta?
Nothing. Just I don't have a large cap fund, so is it okay like having two flexi cap, Parag Parikh and HDFC? Is it okay to have two flexi cap?
Well, smart investor there, Shweta.
It's absolutely fine to have a flexi cap as a replacement to large cap. In fact, even if you look at the HDFC flexi cap portfolio, it has more than 70% of large cap. So you are deriving your large cap exposure.
Okay, ma'am.
All the best. Shweta, let's take Vikram's question, and he says that he wants to invest 7 lakhs for next 6 years, and for that he wants you to recommend good mutual funds. Okay, I think we have Vikram on the phone line. Vikram, hi, good evening. Vikram? Okay, I think the line just got disconnected. Anyways, we'll try to connect back with him. But Shweta, so 7 lakhs for 6 years. Shweta, why is it difficult to have a complete out-and-out equity-oriented strategy when we talk about a time horizon which is between 5 to 7 years? Why is it risky?
So, what happens is with equity, in the short term, there can be increased volatility. So that, if I look at the historical track record of equity, the average 1 year investor could have experienced volatility of as high as, 50%. But as the time period goes by, the volatility reduces. In fact, if you have historical data, and some of my analytics that I have done shows that if you've had a holding period of more than 7 years, equity is given positive returns for the thousands of observations that we would have seen from 2001. And as the time period increases, the probability of it giving you more than what debt would give you, like more than 6% of debt return, also goes up by to almost 95, 98% plus. So therefore, it becomes very important that if you are looking at equity, you should have a longer time period, because the visibility increases of return and the volatility reduces. 6 years is a decent enough time period. I'm assuming this is not your 100% equity portfolio. You do have some debt, and you're only referring right now to the equity portion you want to allocate. I would say you can start off with 4 schemes, which is giving you a good diversification across different market caps. So some schemes here for you. You can go in for an Invesco small cap fund, an ICICI Pru Focus Equity Fund. 2 other schemes that you can add on to would be a Kotak Emerging and an SBI Large and Mid Cap. I'm trying to build, because you have 6 years, also add in some mid-small portion to the portfolio and give you a good mix of different styles. But do review this portfolio once every year to see if you need to make any changes to this.
Okay, I think we have Vikram on the phone line also with us. Vikram, hi, good evening.
Good evening, ma'am.
Hi, so Shweta was actually answering your query and checking your financial portfolio. Is there anything else you want to ask her?
Ma'am, can we talk in Hindi, please?
Sure, बिल्कुल. श्वेता, दोहरा पाएंगी आप? मेरे ख्याल से जो आपने उनको फंड्स रेकमेंड किए हैं, इन्वेस्को इंडिया स्मॉल कैप, आईसीआईसीआई प्रू फोकस्ड इक्विटी, कोटक इमर्जिंग इक्विटी और एसबीआई लार्ज एंड मिड कैप.
जी बिल्कुल, यही 4 स्कीम्स थे विक्रम. इसे हर साल रिव्यू करना अपने पोर्टफोलियो में, ये शुरुआत के लिए सही है. और आपको एक अलग अलग फंड मैनेजर स्टाइल का एडवांटेज मिल रहा है, डाइवर्सिफिकेशन मिल रही है. और आपके पोर्टफोलियो के लिए इक्विटी डेट की एलोकेशन मेंटेन करना बहुत जरूरी है. तो ध्यान में रखना कि कुछ डेट भी हो आपके पोर्टफोलियो में. बाकी इक्विटी के लिए ये मैं कहूँगी, जोखिम को ध्यान में रखते हुए और एक रिटर्न के पोटेंशियल को ध्यान में रखते हुए मैंने आपको रिकमेंडेशन दी हुई है.
Okay.
All the best, Vikram. If you've missed anything, you can watch this show on our YouTube channel also, and you can note down all the funds name as well. Thank you so much. And with that, it's time up on the show. Thank you so much, Shweta, for helping our viewers with their financial portfolio queries. And for our viewers, I'm going to leave you with our WhatsApp number and email ID. Thank you so much for watching. Goodbye.